The secret behind interest rates and how they affect your life. Did you know there's an invisible number that quietly controls your financial life? It decides how much you pay on your credit card, how much you earn in your savings, and even whether a country falls into recession. That number is the interest rate. In today's video, we'll explore where interest rates came from, how banks and governments use them as weapons, and most importantly, how they affect your everyday life. By the end, you'll understand interest rates better than 90% of people, and you'll know how to use them to your advantage. 1. Historical origins. Mesopotamia 2000 BC. Clay tablets recorded grain loans with interest of around 20% per year. Aristotle condemned interest as money breeding money, something unnatural. Rome imposed legal limits on interest and sometimes canceled debts during crises. Middle Ages. The church banned usury, but Jewish and Lombard moneylenders filled the gap. Renaissance. The Medici family in Florence legitimized interest as essential for trade. Adam Smith and Keynes reframed interest as the price of money over time and a tool for balancing savings and investment. 2. What is interest? The price of money in time, what it costs to borrow or what you earn by lending. Key distinctions: nominal versus real. Nominal ignores inflation, real subtracts it. Fixed versus variable. Fixed stays the same, variable changes with the market. Lending versus deposit. What banks charge versus what they pay. Simple versus compound. Compound grows on top of itself, interest on interest. Example: if inflation is 10% and your savings account pays 8%, your real rate is minus 2%. You're losing money even if your balance grows. 3. Impact on daily life. Credit cards. With 22-30% APR, the minimum payment is a trap. Balances snowball. Mortgages. A 1% higher rate can add tens of thousands over 20 to 30 years. Savings and investments. High rates give safe instruments like CDS become attractive, stocks fall. Low rates gives borrowing and investing boom, stock markets rise. Consumption and jobs. High rates cool demand, slow hiring, and increase unemployment. 4. Interest rates as policy. Central banks use rates to control inflation and economic growth. Historical cases. Great Depression. Rates fell to try to restart credit, but confidence was gone. Volcker Shock 1981. U.S. raised rates to 20% to crush double-digit inflation. Painful recession, but inflation collapsed. Japan's lost decade. 0% rates, deflation, no growth. 2008 crisis. Near zero rates plus quantitative easing. COVID-19. Zero rates plus liquidity injection gives inflation after May 2021. The psychology of credit. 32 minutes and 0 seconds to 37 minutes and 0 seconds. Present bias. We overvalue immediate pleasure, undervalue future cost. Minimum payment anchor. Seeing a small minimum tricks the brain into thinking debt is manageable. Illusion of cheap credit. 0% for 12 months hides fees or future increases. Example: financing a $1,000 TV on a high-interest card can double its real cost. 6. Practical strategies attack high-interest debts. First, debt avalanche method. Compare real rates, nominal minus inflation. Refinance mortgages or loans when rates drop. Use low rates for productive investment, education, tools, business, not depreciating consumption. Build an emergency fund. 3 to 6 months of expenses, more if income is variable, so you don't depend on expensive credit. 7. Final reflection. Interest rates aren't just technical jargon, they are the price of time and risk. They shape your debts, your savings, your job, and even your country's economy. By understanding them, you protect yourself from financial traps and gain an edge in a world where most people are flying blind. So next time you hear the news say, the Fed raised rates or inflation is pushing rates up, remember it's not just a headline. It's money out of your pocket or opportunities for your future.